You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 10/12/21. Well, transitory inflation seems to be yesterday's meme or theme, depending upon how you look at it. Now, purported tapering, employment numbers, all these things, how are they going to fit together? Well, if you listen, you'll hear in a moment. Our good friend Jim Welsh is back, macrotides.com. So, Jim, the transitory inflation, not so transitory.
No. And, as you know, we've talked about it in our conversations. And for months and months, I've been pointing out all the reasons why inflation was going to run hotter than what the Fed anticipated and persist longer. The only thing that I would say is noteworthy is a couple of weeks ago when Powell testified before Congress, he never used the word transitory a single time, and he acknowledged that some of the supply chain bottlenecks and inflationary pressures were likely to last longer. And I don't think it's any coincidence, Kerry, that, all of a sudden we've seen treasury yields start to head north. And I think, up until that time, I think a lot of people just wanted to believe that inflation would be transitory. It was kind of an easy concept at first to begin with, based on base effects, year-over-year changes and so forth. But, the reality is that there's a lot of dynamics at play here. Wage growth, shelter inflation, all these things are going to keep core inflation higher than the Fed anticipated. And I think it's going to be a continuing problem as we get into the first half of next year.
Well, by some accounts, the inflation rate is running at 14%. I don't necessarily take issue with it. Look what's happened in natural gas. Look what's happened to all commodities.
Yep.
Nat gas up 100 till its recent retreat was up 130%. Gasoline still going higher. Oil, $80 a barrel oil. All of this is directly attributable to the government's Fed's actions, printing up trillions in new currency units. How are they going to back out of this? How are they going to put the toothpaste back in the tube here, Jim?
I don't know that can happen. The reality is that inflation, this surge, is going to reach a higher level or plateau. And so all the people who are earning more money, those wages are going to stick. So you basically have ratcheted up the cost basis for a lot of companies, things like energy. Ultimately, are they going to pull back? Yes, they are. But, the real important one is wages, because that's the biggest cost item for most companies. So they're not going to be able to get it back in the bottle. And ultimately, I think, whether it's 2 years or 4 years, I think we're going to see a big unwind. And I continue to believe that deflation is probably the bigger risk, because ultimately things like population growth, lack of productivity growth, that really is what determines GDP. So once we get through this bulge over the next 12, 18 months, I think we're going to see GDP settle back down to the sub 2% rate. And at the same time, we'll have an enormous amount of additional debt that has been layered on over the last 2 to 3 years. And that is going to be quite a burden for economic growth going forward. So, again, I think we're going down a path that is basically a dead end, but they're going to play out the string as long as they can to try to, keep the game going. It's that simple.
So isn't the Fed really just trying to scam us?
Well, I can't say scam. Scam is when you hide stuff from people. This is right out in the open, Kerry, in terms of what they've been doing with the QE and so forth. It really comes down to is most of the folks in this country are economically illiterate. And, and I don't mean that pejoratively. It just is what it is. And the net result is most people don't fully understand some of this stuff, and it just goes over their head. And then they're going to listen to politicians who may actually know less about a lot of this stuff, and they'll just listen to whatever the screed is from the politicians, and that's what they're going to run with and accept. So, they can get away with this only because most people aren't paying attention. And again, if you think about it, the government handing out multi-trillions dollars of money directly into people's accounts. Most people are in better shape today than they were before the pandemic. And so why would they want to be critical or question what has been going on? So, that's how you buy votes for the next election, too.
It's a sad commentary here, Jim. A real sad commentary. So what's going to happen with precious metals? It's been slammed lately, but looks like it's showing a little signs of life.
Well, that's one of the things I think, Kerry, potentially Powell's lack of transitory and acknowledging that inflation is going to be around for a while. I think potentially that is going to open the door for a rally. So a couple of weeks ago, I was looking for gold to dip into the 1720 to 1730. I thought if it did, that would be a good buy point. What gold needs to do is get above about 1785. And if it can do that, I think a run towards 1825, 1830 is coming. So short term, I'm bullish because I think Powell changing this tune. And if we get a CPI report that comes out on Wednesday morning, that I think is going to surprise people. The last couple reports, inflation eased a little bit, but used car prices in September are up over 5%. As you noted, energy prices are up huge. So the headline number, I think, potentially could tick higher. New car prices are up 17% from a year ago. So there's a lot of, again, dynamics going on. We've seen wage growth. Shelter inflation hasn't really bled through to the extent that it will over the next 6 to 12 months. So again, I think there's a chance for a negative surprise. And looking at the chart of GDX, there's a trend line going from the high back in early June that as we're talking, GDX is above it. That trend line is around 30.50, 30.60. So to me, what that is signaling, I think, is we're going to see a pop in the metals. And I think the gold stocks are going to, have a move higher in the next, 3 to 5 weeks.
All right. Well, that is not surprising, but hey, it's kind of what we expect here. So in the next couple of weeks, that quickly, huh?
Yeah, I mean, again, technically things have been building up. And I think, again, Powell's acknowledgement that inflation is not going to be transitory. I think there are a lot of people who wanted to believe that because that meant status quo in terms of monetary policy. Rates would stay lower for longer, which is good for mega cap stocks. And, I guess one could translate that into the economy as well. So to me, what the charts are signaling is I think gold is going to rally and the gold stocks are going to follow suit. And I think we're on the doorstep of that move higher.
All right. So what about the economy at large? It looks like it's really slowing down, doesn't it?
Don't just survive, thrive. The Financial Survival Network.
FPX Nickel is developing the large-scale Dakar Nickel District in central British Columbia. Within the district is FPX Nickel's PEA stage Baptiste nickel deposit, which is projected to be among the world's top 10 largest nickel mines by annual output. The Baptiste deposit has the potential for the lowest quartile operating costs at just $2.74 per pound. And compared to recent global nickel mines, the project requires a low capex. FPX is also commencing its first ever drill program at its Van target in the Dakar Nickel District. Surface samples have indicated that the Van target footprint is larger in scale and 10 to 15% higher in grade than Baptiste. FPX Nickel trades in Canada as FPX and on the OTC under FPOCF. To learn more, go to fpxnickel.com. That's fpxnickel.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, it is slowing, but this is what makes it a little bit tricky is because there's demand for goods and services that can't be met. So car sales, I think in September were down 17%. It's not because people don't want to buy the car. There's just no car there for them to buy. And I think that extends to a lot of products, retail stores. their inventories levels are still down 30 to 40% from what would be considered normal. So that is stunting some of the top line GDP growth you would getting because people can't spend their money on stuff that they can't get. So I think what that suggests, unless there's a material change 6 months, 12 months from now, as the supply chain issues start to be addressed and shorten, I think you're going to see the economy and demand continue to be in pretty decent shape. So I wouldn't read too much. I think you have to be careful of reading too much into some of the numbers that are coming out because we do have some demand that just simply isn't being satisfied.
All right. Well, interesting times in which we live. That's for sure. Looking ahead, what about the housing sector? It's kind of been a linchpin of everything. Yep. Over the past year and a half during the pandemic. Does it continue onward and upward, or are rising rates going to nip it in the bud?
I think it's a combination, as you note, higher mortgage rates, because I've been of the view that the 10-year and 30-year treasury yields are going to go back to the March highs, which was 176 on the 10-year, 250 on the 30-year. And as that happens, obviously, we're going to see mortgage rates jump. But the other issue is the affordability issue. So we've seen home sales kind of moderate without mortgage rates going up, primarily because as prices go up, there's a whole segment of people that are renting. Their rents have just gone up significantly. So it makes it tougher for them to save for the down payment. And for a lot of people, it's just out of their range. So I think the combination of factors, Kerry, I think we're looking at the peak in housing was, I think, behind us by 2-3 months during the summertime. You're seeing, multiple bids. The number of bids for every property is falling. The number of houses selling above asking is declining. So to me, those are all warning signals that you've reached a saturation point. So I think housing is going to slow, maybe not materially, but as you noted, it has been an engine of growth. The other issues of, hey, you order a piece of furniture. I've got a number of friends who bought some furniture and they were initially told 4 months. They ordered it in April and May. Okay, it's going to be 4 months. Now they're being told it's going to be at least another 4 months. So, again, that really does act to curb demand. Because if you find out, I'm not going to wait 8 months for a piece of furniture. So those things I think are going to be helpful down the road. But I think housing is going to moderate from here. And then it depends next year how high rates go, because I still think next year inflation is going to continue to be a problem. And the shift that's going to take place is I believe the Fed's going to do tapering, announce it November 3rd. They're going to begin in December. It's going to be $15 billion a month, not 10. That means they'll be done by July. So as we start to progress towards the end of the first quarter next year, if inflation is still uncomfortably high, people are going to start speculating on, well, how many times is the Fed going to raise rates before the end of 2022? So the whole dynamic of the conversation is going to shift as we get into next year. And I think, that is what I think is going to happen. So ultimately, I think the 10-year has the potential to go comfortably above 2%, which, I think is going to be problematic for the stock market. I think we've talked about this. Going back to 1922, the S&P's made an important low every 20 years. There's also the 40-year cycle connecting 42, 82, and now we're talking 2022, and the 20-year cycle bottomed in 2002. So next year is the culmination of a 20 and 40-year cycle. And I think one has to be careful that potentially the table's getting set up for a decline of 20% or more sometime probably in the mid of next year.
Really? Huh.
Yeah.
All right.
Yeah.
Well, aren't you the bearer of glad tidings there? I guess we're going to see what happens, as always.
As always.
The heck knows. Hey, so, Jim, we want to find out more about you, connect with you on the web. Tell us where to go.
Well, I tell you what, Kerry, I put out my weekly technical review every Monday, and I really dissected the employment report in yesterday's technical review. And I'd be happy to send that to listeners of your show. So all they have to do is send me an email, Jim Welsh, WELSH, macro macro@gmail.com, and I'll send the October 11th weekly technical review to them. I've gotten some nice feedback in terms of the analysis that I did of the employment report. So,
all right, excellent. Well, that's great news. We really appreciate you coming on as always. And
likewise.
Hey, we will see what happens here, I guess.
Yep, as always. All right, well, stay well.
All right, you too. Be well.
Okay,
and
Kerry.
hey, questions for Jim, shoot an email to kl@kerrylutz.com, and we will get an answer for you. Appreciate you coming on, Jim, as always. Talk to you again next month.
Thanks very much, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.